Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good weekend all. Ira Epstein of Linn Associates with your weekend edition of your financial market wrap-up. And this is for December 14th, 2018. We're about 3:17 p.m. Central Standard Time, which means we've, if you will, got the settlement prices in now for the stock indices, and it's one ugly day. Those February lows that we made earlier, I think you can look at those as the goal of this market right now to try to get down to. Metal market's getting hit because the dollar is running rampant again, new highs in fact, and we look at all the other currencies down against it, with the exception of the yen, which is getting a bounce as traders buying a little bit of the 10-year note, they're buying a little bit of the bonds, even though they're going into next week's FOMC meeting. There's just fear. It's not rampant, but it's discussed. You've spent a whole year, and come October, all the gains of this market just went away, with large ones in many, many cases disappearing in individual stocks. So as we take a look at the monthly chart, the one thing we know is we're for the month down, and we're down 156.5 points at midpoint. You know, we're at the 14th of the month, so it's about midpoint. And if I come back here, this is the first time, because last month we were not under that 18-month moving average. It's actually the first time the market's done something like this in a very long period of time. Now, because this is a monthly area chart of closes, I can't tell you we're going to close like that, but I can tell you at mid-month we're underneath all that. I can also tell you that we had this downtrend line going and I stopped it there. Now imagine the continuation since 2629.80, and I just want to give you the idea of where this was. This was the big break that ended on November 23rd. It sounds so long ago. We're only at December 14th. We had that bounce. The bounce didn't take out previous highs, and now you've taken out previous lows, which leads me to believe, why not go back and challenge these lows and see if there's anything under the market. When we come to the mini bar chart of the Fibonacci's, you go from the February low to the high that you made, and now you're coming down. So we did stop 3 times just over that 62% retracement from the low to the high, couldn't do anything, and now you're challenging the lows. Again, it puts that number back into play. When we take a look at it as a trend defined by a swing line, and what a swing line does, for those of you that may not know, you will hear not just from me. Turn on your financial TV. Any chartist worth his merit is going to talk about is the market making a pattern of higher highs, higher lows, lower highs, lower lows. Is it trending? And that is the universal way of looking, is a market trending? Then you're looking to say, is it staying with the downside bias within the trend? Is the momentum picking up? So on and so forth. I developed a tool, it had to be 20 years ago now, that I wrote into charting software, and what it does is it looks at highs and lows by looking at the bar before it. The bar could be a day chart, a 5-minute chart, whatever it is, and it plots according to one of 5 rules that I did so that I can see, is the market trending and what is the risk associated with the trend. The definition of risk is what number would the market have to go to invalidate that pattern. That's the way I look at it. Well, you've got lower highs, lower lows, you're back in a downtrend. If I take this week out, right through here, you had a market with lower highs and higher lows. Do you see that? Now you came up, and now with this week, you put back in the downtrend pattern. So you had a stall, and now you're back down. And you'd have to get up all the way here at 28.14 to break that. That's 200 points, pretty far away. Where the market stopped today was the 100-week moving average of closes. The long-term traders will look at that, but they'll focus more on the 200-week. That seems to be their baby. But when you're dealing with weekly charts and you're looking at a 100-week pattern, it's a 2 years amount of it. It's quite a bit. In terms of Bollinger Bands, these black dashed lines, Bollinger Bands are an algorithm designed to keep the market trading within them 95% of the time. 5% of the time they will step outside of the band. What you have to be concerned about is, number one, is it a sideways pattern that the market's trying to break out from to the upside or downside? After it's done that, does the market ride the band? This is called riding the band. Markets that ride the bands don't get far away from them often. In this case, it did. You'd get under the band, get a hard rally, and each time you would find resistance at these upper 18-week moving average of closes, what I call the line in the sand. I look for a neutral point on a chart, which I call the 18-week moving average or the 18-day if it's a daily chart. If a market's under it, it often rallies to it, and that's where the decision has to be made. If the market's above it, it can often break to it and try to make its decision from there. Go plot it. I invite you to do that. If you take my charting course, which we've reduced it 33% for Christmas, you learn this really fast and how to keep up with it. But you're down at two numbers. You're down at the 100-week average, the lower Bollinger Band, and momentum is still pointing down. On the weekly charts, I don't look for overbought, oversold momentum. I just look to see, is the market going sideways, which means still bullish? Is it pointing down, still bearish? Pointing up, it's bullish. Those are the things I'm looking for. I see everything bearish. The gold line is where the market finished for 2017. So we're underneath where we were, and that number was 2676. We're 75 points lower. Financial TV will have you believe the whole market has come apart. It's very close to unchanged to slightly lower. In the NASDAQ, the market looks like it wants to again challenge. It only challenged one time last year's closing price. Here too, the trend is down on the weekly charts. Lower highs, lower lows. Support comes in at the lower Bollinger Band, 64.39, to the 100-week average at 64.11. I cannot say anything on these charts is bullish so far. In the Dow, lower highs, lower lows. We have fought now 3 times since October, bounced each time away from where you finished 2017 at, and finally you're back under it. If the market wants to stretch this breakout, as I think it's going to try, it wouldn't be surprised if you make a run towards that 100-week average. And as I said, you got to come all the way back here and keep your eye on this February low, because it's a logical target for the market to try to reach for. Does it have to? No. Does it have to really keep dropping? It doesn't have to, but the odds are it's going to. In the Russell, same thing. Lower highs, lower lows, under where it finished, momentum down. I can go blah, 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 and you can come back here and you can see this February break low. So why not take that market and make your run forth? If there's nothing under there, that could start the area where traders said, okay, end of the year, Christmas coming, don't want to be around, traders going on vacation, blah, blah, blah. Maybe it's time to stop pressing. And how much liquidation are you going to get? That's been the problem. You're getting a massive amount of money that have been selling out of stocks into money funds. They're on the sidelines. I doubt they're going to commit if they don't have to for the rest of the year, but we'll see. In the VIX, you got up to the resistance of the upper Bollinger Band. You're pulling back a little. Momentum up. The bias is up because you're over the 18-week average. In the 10-year notes, if the market wants to rally further, maybe it gets to the upper Bollinger Band. I have a hard time wanting to be that friendly at this number beyond that because of the FOMC meeting, and it depends what the Fed says. You know, if the Fed comes out super hawkish, you could blast up. If the Fed does more likely, say it's going to raise interest rates, it's going to be data dependent and gives you the reasons to confuse a little bit by design, maybe we're getting high enough. But the trend is up, the bias is up, momentum is up. And that's on the weekly charts. Daily charts are not in that camp. On TLT, trend up, higher lows, higher highs, over the 18-week, momentum up. Resistance all the way 121.40 to 122.55. Support back at the 18-week average at 116.44. Dollar index, new highs for the move. Each time it's done this, it's been very well constrained by that upper Bollinger Band, but anything priced in dollars has a problem. The dollar keeps going up and everything else keeps going down. Probably a good time to go to France, like Liz Clayman was saying, and spend some euros. And those euros, look at how they keep coming down, and you've got now a reversal week to the downside. So lower highs, lower lows, momentum down, bias down. Mario Draghi's speech, he's not raising interest rates anytime soon, if you heard the speech, and they are going to not allow their balance of their book to roll. Like the US, you know, everything's mature. We don't put it back in the market. They're rolling it. It matures, they put it back in the country where they bought bonds at. But they're not buying new bonds with new money. They're using old money to buy the bonds still. Pound, down and away. If you want to bet on Brexit, great, but the market is saying the bet should be to the bear side. Canadian dollar, riding the lower Bollinger Band, momentum down, still a very bearish scenario there. Japanese yen, well, now the market's climbing. The last high this market made was 89.15.5. It did not do it this week. It hit 89.14. So we have a pattern of lower highs and higher lows. It's not really a trend. You've got to be a little bit careful of that. Bitcoin, I realize that I look at Tom Lee and some of these other guys, and they keep saying, you know, I'm not going to pinpoint the time, but the market's going higher. Well, they were saying at 18,000 it was going higher, then 12, then 10. I'm not picking on Tom. It's everybody that loves these Bitcoins is wrong. And the market for this week down again, $175, 31.25. When you look at what's going on with the differential between Brent and WTI, sort of stalled out here at about $9.10. But oil prices look terrible. You have to get back over 63.71 to have a problem. I just got off. I was talking on the floor to one of the oil analysts as I was doing the show for Fox, and we were talking, and he's explaining that there was just an article, which I have not read, about the frackers in the Wall Street Journal, people doing the fracking, that even at $70, I have not read the article, he was telling me most are not making money because of the cost of capital and other things. Interesting. I have not read the article, but I want to. Momentum locked in bearish, trend down. You'd have to take out 54.55, in my opinion, on the weekly chart to negate the downtrend. Gasoline prices still breaking away. All the seasonals in gasoline that I know of are pointing up. Stock seasonals pointing up. Markets aren't paying attention to them. And last in the nat gas, you got to be a weatherman to play this market at this time of the year. Lower highs, lower lows. Trend down, bias down. Maybe the market gets back to the 18-week average to get its feet back under it. My charting course. I've put together, as you know, my charting course, but I've put it together in a neat way where you now get so much more out of it because you're able to use our futures trading kit with it and everything else. Now, normally, for the 6 hours of videos, the charting software that comes with it, all the data that feeds the charting software, it was $149.95 for the holiday. Right into Christmas, $99.95. And yes, if you give my staff a call, we can make it a Christmas gift, send it to the person. When they're ready after the holiday, turn it on for them, whatever they'd want to do. For yourself, what a great gift. It's a lot better than a sweater you wear a couple of times and you decide it's not that good for you. You get access to my morning subscriber video, which you don't see on the internet anywhere. You got to be on our website with a password and so on. To get all this, and believe me, it's all over the internet, so there's nothing coming in the mail. Either call my staff, they'll help you. You can go to our website. You don't need a special code. On the website, go to the education part. It all comes together from there. You'll see it. Watch the videos, purchase the course, enjoy Christmas. I'll see you next week, and I'm Ira Epstein.